Hi there, welcome to our question of the week. Today's question is a question I've been asked multiple times over the past few weeks and is really a highly relevant one for the situation where we are today. So the question is, look, if I can earn 5% on cash, what am I doing investing with all the risk that entails? And look, it's a great question because when you look at your statements and anyone who's looking at their investments over the past couple of years, most likely you're looking at numbers that are slightly down, if not flat. And as well, during that time, have had some significant volatility, so some significant ups and downs through that period. That can be uncomfortable. And so the idea of a fixed 5% return on no risk is eminently attractive. I can totally understand it. So if we look at some of the rates that are available today on the market, you can see here, these are the top easy access accounts available. Newcastle, Chip, Crew Bank, these names I've not heard of personally. Sainsbury's Bank I have. So you can get around 4% on an easy access, and for a 1-year fixed term you can get about 5%. Now I can see the attraction with that. But let me just kind of take a step back and talk about something which we talk about with all our clients in terms of their financial planning. And this is where we think about the bigger picture. So we just don't think about your money as one single pot and therefore having one single strategy around that pot. We think about your situation across different time frames. So that time frame, we look across 4 different time frames typically. There's the immediate time frame, short term for around 3 to 5 years, medium term for slightly longer, 6 to 10, and then the long-term time frame for anything above that. And when we think about your situation and your assets in that regard, it helps us, it allows us to start looking at the assets and start allocating assets to each particular time frame. And that really comes down to you in terms of your situation and realistically, when are you going to need that money? So, for example, if you are thinking about doing a big house renovation within the next 18 months, there is no point having a bunch of money tied up in 100% equity funds that will have potential growth, yes, but will also have significant volatility in that, and you may get back a lot less than what it is worth today because markets do what markets do, which is that they fall sometimes. So if you need that money in the immediate term, cash is definitely the best way to go. And look, 5% or 4%, whatever you can get, is very, very attractive for today. However, as we move out the time schedule and the time horizon, that fixed cash rate becomes less and less attractive. And the main reason for that is our wonderful friend inflation and also through the history of investment markets. So I wanted to highlight this particular chart here, which shows you the long-term annualized real returns between 1900 and last year. And you can see the performance difference over that significant long term. Now, as much as we'd love to all live 122 years, maybe not, you can see that the equities, there is no comparison with equities as the true store of wealth over that period, and that store of wealth is effectively, I was talking to a guest on my podcast last week, and he described it as a call option, as an option on human ingenuity. And I think, you know, we've all seen the advances of human ingenuity over the past couple of years with the pandemic response and the vaccines and developing that so quickly. Humans have a way of developing and growing, and capitalism supports that. And equities are the way that is played. So on a really long-term horizon, there is no comparison for 100% equity as performance. And so with the equities, what comes with that is the volatility, as we all know, as we've seen it through 2000, we've seen it through 2000, we've seen it through 2008, we've seen it through the last couple of years as well. And so over that time period, equities do accrete in value, but that comes with the price, and that price is volatility. And so it's being able to stomach that volatility over the long term is really what gives you that long-term price return. So when we think about 5% as a fixed return, great in the short term, but in the long term, that 5% is not going to hang around forever because rates are going to move around. There is also going to be markets are going to recover, and frankly, markets have recovered. And in dollar terms, the S&P 500 is up around 15% already for the last 6 months. And then there's the timing issue in terms of, all right, if you move money from an investment to a cash at 5%, at what time do you do it? At what time do you pull it back out? So the simple question is, shall I take 5% on my money? Sounds very simple, but it's actually a lot more complicated and requires us to break down your financial plan in a lot more detail and start looking at the individual components. Certainly for a component of your funds, yes, it might be suitable, but for the vast majority, it probably won't be suitable. I hope that's been helpful and answered some of your questions. Any comments, please put on the, or questions, please put on the comments below. Look forward to seeing you soon. Bye-bye.